if people are talking about bubbles, I think there are bubble-like characteristics in the euphoria surrounding gold and silver.
The dollar just hit 4-year lows. Ray Dalio says we're watching a monetary order break down in real time. So is this it? Is this the year that the dollar dies?
It's geopolitical to some extent because the world is looking at the evolution of a new world order. The dollar remains the reserve currency of the world. The gold price is in dollars. I can't see a world in which countries' central banks are going to be very happy to own the renminbi. And I just don't see that as a sort of viable option. Having 70% of your equity assets in the S&P 500 would have been a mistake last year, and it would be a mistake now. At last, somebody seems to be agreeing with me.
Welcome to Noise Cancelling. I'm John Adair, and I'm joined, as always, by Neil Woodford. Neil, it's been a big week in semiconductors. SK Hynix and ASML both reported this week. You've been talking about this, Neil, about the picks and shovels approach to AI for over a year at this point. This week must feel like the thesis is finally starting to play out.
It is, yes. I think what we've seen this week is the sort of crystallization of what those that have been following the semiconductor sector have been saying now for a while. I remember this time a year ago, on the whole, industry specialists that follow this sector were still pretty bearish. In fact, some of them remain bearish well into 2025. And I think they were conditioned by what's traditionally been a very cyclical industry, with inventory and price cycles that have been pretty volatile and pretty damaging in a down cycle. So much so that some of the leading companies that we've just talked about have in the past been loss making at the worst point of the cycle. So you could sort of understand why in the past this industry and the companies that lead it have not attracted particularly high ratings, but they've not been particularly highly regarded by investors. But something significant, I believe, changed with the AI industrial revolution and the huge amount of investment that was going into AI infrastructure. And that's really what triggered me to sort of take a fresh look at this space. And I think you're seeing that now play out significantly.
So we've got 3 companies and 3 sets of blowout numbers. Let's just paint the picture for listeners who might not know the names. First of all, there's ASML, a Dutch company that makes the machines that make the chips. SK Hynix is Korean, it makes memory, and there's Micron as well, which is an American business also making memory. How did these fit together into the AI supply chain?
In a way, the AI industrial revolution can't happen without these businesses. They are integral and vital to the technology and how it's applied and how it's used. So what we see is, as users of AI is of course the end product, but what sits behind it in terms of what's in data centers, what's in NVIDIA's GPUs and the ingredients and how they're made. These companies are really involved in all of those steps. So ASML is the world's leading manufacturer of chip-making machines, highly technical machines. Some argue they're the most complicated machines in the world. They cost up to $400 million each. And the company that makes them, ASML, a Dutch company, has 100% market share of that particular part of the industry. And they're incredibly technical machines. They've taken decades to develop and to evolve. China, for example, is not allowed to have access to the high-end machines. So sophisticated are they and so important and vital are they to this AI industrial revolution, because you can't manufacture the high-end chips, the leading chips that all of the Mag 7 are now using and deploying in their data centers. You can't use those chips, or you can't make them without the very high-end machines that ASML manufacture.
ASML reported this week 13 billion euros in orders against expectations of about 6 billion. So more than double what the market was expecting.
Yeah, those were the orders that the company received in the fourth quarter alone. And as you say, the number was double what the analysts, the experts who follow this company, every day, and have been doing so for a long time. The experts reckon that it was going to be roughly half what those new orders were. And what those new orders reflect, I think, is the very strong demand, the underlying very strong demand for high-end chips. Which are sold out, as Micron said in December very recently for this year, and demand is expected to grow significantly. The companies that make the chips need to build more infrastructure. They need more ASML machines, so they're ordering a lot more machines. So the sort of demand cascades through the industry and ends up, frankly, in companies like ASML, which make the machines, and in SK Hynix and Micron, who make the chips that go into, for example, NVIDIA's GPUs.
What makes ASML so special? Why are they the only ones that can deliver numbers like this?
It has taken decades of technological evolution to be able to produce these machines. They are, as some people argue, the most sophisticated machines mankind has ever produced, and as a result of that, there is a concern, frankly, about the level of sophistication that I mean, first of all, mimicking that sophistication is very, very difficult, nigh on impossible, clearly. Otherwise, ASML wouldn't have 100% market share. But I think over and above that, the sophistication of the machines and what they enable their customers to do has become so important to the West, and indeed to the US in particular, that they don't allow ASML to sell their high-end machines to China. Albeit that China, I think, accounted for about a third of the orders in Q4, but China is ordering the less sophisticated machines. It certainly is not allowed to have access to the top-end EUV machines.
Now, on the memory side, we've got SK Hynix and Micron, which you've already mentioned. Both have put up extraordinary numbers. SK Hynix doubled its profit. Its operating margin is 58%. Micron's revenue is up 57%, and they've sold out their entire 2026 supply. Neil, for listeners who keep hearing, or perhaps are hearing about HBM, high bandwidth memory, for the first time, what actually is it, and why is everyone fighting over it?
Right. Well, these are highly sophisticated memory chips. So traditional DRAM and NAND chips are essentially commoditized to some extent, and you see sort of cycles in demand and supply and in price of those chips. But the AI industrial revolution has created a new level of demand for much more sophisticated, much more high-performing memory chips. And these are the HBM chips that only Hynix and Micron are currently able to produce. I think Samsung is the third supplier, but it's been really struggling with its HBM product. It appears now just to have had that approved, I think, by NVIDIA. So Samsung will start supplying HBM chips going forward, but hitherto the market's been dominated by those two companies, Micron and SK Hynix. Hynix has got an over 60% market share. Essentially, think of an HBM chip, I think, as a sort of multi-layered DRAM chip. So they have far more throughput than traditional memory chips. They are much more sophisticated, much higher throughput. They are what is needed for NVIDIA's latest generation of GPUs to perform as well as they do, and they're a vital ingredient in the ability of those chips to become more powerful. And so they are a key ingredient in this AI industrial revolution.
Let's talk about SK Hynix. Since they just reported, their operating margin of 58%, their profit more than doubled, and they're apparently now the exclusive supplier for Microsoft's new AI chip. It's a Korean company. Most people have never heard of them, but one thing caught my eye. An analyst said the memory industry is breaking free from traditional cycles and moving towards long-term supply contracts. Historically, memory has been brutally cyclical, boom and then bust. Is something structurally different now, do you think?
I think it is for the time being. HBM chips now occupy a significant proportion of SK Hynix's manufacturing capacity, because the demand for these chips is so strong. They're higher margin, they can charge more for them, they're higher performing, but they have eaten up, if you like, a huge proportion of SK Hynix's production capacity. And as a result, that's creating shortages in the more commoditized NAND and DRAM chip markets, where prices have gone up hugely in the last few months. I think I would say over the last quarter, prices are up in some DRAM markets are up over 100%. So there is a sort of virtuous circle here. The huge demand that the AI industrial revolution is placing on key suppliers like Hynix is squeezing the capacity of the industry to fulfill the sort of more day-to-day demand for commoditized chips. And as a result of that, their price has gone up very significantly. So Hynix is in a very uniquely good position. It's winning on all fronts currently, in that it's capitalizing on the higher margin, more sophisticated HBM market, but at the same time seeing very strong pricing in its commoditized, more traditional market. Now, is this the end of boom and bust in this market? No, I don't think so. But I think what we should expect is that we're going to see the cycle change, if you like, and elongate. Hynix said very recently that it was forecasting nearly 40% compound annual growth in the demand for HBM chips every year to out to 2030. Now, that tells me that there's a sort of a significant fundamental shift because of what's happening in AI in the semiconductor cycle. So I'm not saying the cycle has ended. I'm not saying that we're in some new paradigm. I am, though, saying that the characteristics of the cycle have been completely altered for the time being, and as far as I can see into the future, by this AI industrial revolution.
For someone who might already have some NVIDIA in their portfolio, how do these names fit alongside? Of course, without getting into specific recommendations.
Yeah, well, NVIDIA is the largest company in the world. It is highly rated and highly regarded, and trades on a high multiple. Maybe not as high as some people might think, but I think between 20 and 30 times next year's earnings. Hynix, bizarrely, I think on upgraded forecasts, their PE for next year is something like 6 times earnings. So they are seen as very different. And I think the rating of Hynix reflects the fact that it has this very cyclical historical legacy. And for the reasons I've just explained, I think that cyclical perspective will have to change for the foreseeable future.
Okay, well, let's shift gears slightly. Ray Dalio was at Davos last week, and he said something that's been rattling around in my head ever since. He talked about a potential capital war, which is the flip side of a trade war. The facts are, though, that the dollar index has hit its lowest point since February 2022, down about 10% over the past 12 months. Trump's dismissed it. He said it's fine. Meanwhile, gold is at record highs and central banks are buying. How seriously should we take this death of the dollar narrative?
It's a big subject, and I Ray's a very, very smart guy. I don't know Ray Dalio, but he's clearly a very smart guy, a billionaire, and a very successful asset manager. But I do disagree with these more alarming sort of the end of the dollar type, that sort of call. This is partly financial market, partly geopolitics. We know, and we've talked about this on previous podcasts, we know that Trump has effectively ushered in, albeit that I think he's not the only catalyst for this thing. I mean, clearly the geopolitical confrontation between China and the US is not a product of Donald Trump. It's been there. It predates Donald Trump, but of course, but it's been brought into stark contrast by the trade conflagration that took place last year, and by the more explicit sort of geopolitical maneuverings that we've seen in since Trump became president in January last year. So I think it's geopolitical to some extent because the world is looking at the evolution of a new world order, if you like. And I think that's centered around the emergence of two superpowers, China and the US, and the fact that they will confront each other. And the world is adjusting to how that sort of new order will play out. And clearly, the way that Trump has treated his allies in NATO, for example, maybe that treatment was well deserved. But nevertheless, the sort of narrative that we've heard, for example, at the Davos sort of shindig that we've seen very recently, sort of, I think, is good commentary on how the West is responding to this sort of new world order. And I think the fact that central banks are buying gold in the way that they are, many are. I don't know which ones, how much they bought, who is and who isn't, but we know in general central banks have been buying gold. Of course, the UK sold all of its gold, thank you, Gordon Brown, some years ago. But nevertheless, central banks are buying gold, and what we're seeing now, I think that for me is a sort of a geopolitical hedge. But the dollar remains the reserve currency of the world. All commodities are on the whole priced in dollars. The gold price is in dollars. I can't see a world in which countries' central banks are going to be very happy to own effectively the only long-term viable substitute for the dollar seems to me to be, in terms of fiat currency, seems to me to be the renminbi. And I just don't see that as a sort of viable option. The euro has a sort of part to play in all of this, but I don't see any more the euro, unless the Eurozone economy starts to wake up, frankly, and unless the Eurozone starts to function more successfully as an economic and geopolitical sort of area, I don't see the euro as a viable alternative either. So I just think this is about fragmentation. It's not really about another currency or some other medium becoming the alternative to the dollar. I mean, and one has to look at these things in a longer term context. 50 years ago, sterling was 260 against the dollar. We've had a very, very long run period of dollar strength against pretty much everything. And now some of that's reversing. But I can see why Trump likes it. I mean, it makes US exports cheaper relative to everything else. Of course, it's disinflationary for an economy like the UK, because most of what we import, and certainly the energy that we import, is priced in dollars. So, it's slightly disinflationary for an economy like the UK, which is frankly good news. And I can see why Trump likes a relatively weaker dollar as part of his sort of Make America Great Again strategy, to attract more manufacturing into the US, to restore, if you like, the US's manufacturing prowess of old. But I don't see this, frankly, as the end of something. I don't see this as the end of the dollar at all. Remember, for all of the sort of hubris and all of the sort of bluster that is Donald Trump and his proclamations, the fact is that he is having quite a lot of success in a number of key industries. And I'm thinking here of semiconductors, I'm thinking here automotive, I'm thinking here of pharmaceuticals, a lot of manufacturing industries that might in the past have been happy to sort of locate their factories in Europe or in Eastern Europe or in Asia and export to the US. Donald Trump's basically said, no, not anymore. If you want to sell in the US, you've got to come and make here in the US. Now, that's going to, in the medium and long term, have a significant impact on the US deficit. So the trends that the scale of the deficits we see now, I think will shift over time.
Dalio made one other point that might be relevant for our listeners. And he said if you were Swiss and you looked at the US stock market returns over the last year, it would look very different than if you were American. For UK investors, how should we think about that?
Many investors who look at the long-term underperformance of the UK market, have taken, if you like, have bought into the sort of idea that they should index relative to the global index, the MSCI, for example, and have some sort of, that should be the sort of base from which they construct their portfolios. And of course, because the US stock market has outperformed for so long now, on various measures, the US index is something like 65, 70%, on some measures even higher, 70% of the MSCI global index. So investors in the UK who are not thinking domestically have already probably got a significant proportion of their assets invested in dollar securities. The dollar return is something that they have to think about. So they have the market return, of course, but then if the dollar is falling, then that, of course, it undermines their sterling return.
There was an interesting chart that I saw this week, which was the returns of the S&P 500 measured against gold, in gold terms, effectively. And everyone thinks the S&P 500 is, going to the moon, and you can't lose if you invest in that. But compared to gold, which I admit is perhaps not responding completely rationally right now, but compared to gold, actually, it looks like the market's in freefall.
Yeah, it's at a multi-year low. That's because the gold price has gone up so much. Yeah. I mean, if looked at through that lens, you'd be tearing your hair out. But of course, looked at through another lens, I mean, how many people are using gold as their currency? I mean, it's the preserve of the very rich as a store of value, the very wealthy, and of course central banks. But it's not a medium of exchange. So I think it's a slightly academic argument. The S&P to most investors has been an incredibly good investment over many years. I've argued that that's largely played out and that other markets are going to look more attractive going forward. And that was certainly the case last year. And in dollar terms, it looked even more significant. And so far this year, in dollar terms, the UK market is up significantly more than the US, and indeed in sterling terms too. But it's only the 28th of January, so it's far too early to make any calls about that. But no, it's an interesting sort of anecdote, but I don't think it really tells you anything more than the gold price has been very strong because there have been a lot more buyers than sellers in recent months. Does that continue? I'm not sure. I think there's a degree of sort of, if people are talking about bubbles, I think there are bubble-like characteristics in the euphoria surrounding gold and silver, for example, far more than there is a bubble in and around AI. It seems to me to be far more hysterical.
I'll leave a link to that in the description and in the little button just above if anybody wants to watch that episode.
Yeah, I would just caution people to not get carried away. But in terms of the question that you asked originally just now, John, my sense is that, in my opinion, having 70% of your equity assets in the S&P 500 would have been a mistake last year, and it would be a mistake now. I just think that's too big a bet.
Well, I'm sure this de-dollarization narrative will keep coming up for a while, but your argument is that the dollar's dominance is more durable than people think.
Yes. I don't see anything else replacing the dollar anytime soon.
Neil, let's try and bring this together for people. We've talked about the AI supply chain, the picks and shovels. We've talked about Dalio's warning on the dollar. For someone listening, thinking, what do I actually do with this information? Let's try and talk about stress testing an investment strategy. If someone looked at their strategy today, a lot of people probably are heavily weighted to US stocks, to dollar assets, and to technology, perhaps not even deliberately. What questions should they be asking themselves?
Anybody who's had a big weighting to the US over recent history, 5-10 years, they've done incredibly well, and they've done a lot better, frankly, than if they had a UK-focused, for example, portfolio. But I think, as I've been saying for a while now, I think that story's played out. Concentration, too much concentration in any portfolio, I would say is not advisable. So I think, although I'm still also a subscriber to the diversification sort of philosophy. You can be too diversified, and Warren Buffett has echoed that on many occasions. Similarly, too much concentration is equally a mistake.
You talk about Warren Buffett. I wanted to ask you this question quickly because we talked last year about how much exposure he had to cash to the US dollar. Do you think he's kicking himself for that decision now, given where the US dollar's headed?
No, because what you've got to think about is unless I was coming on to this, when people think about where they position their assets, they've also got to think about where are their liabilities, where are they going to live, where are they going to spend their money, where are their kids going to go to school, where do they want to buy a house, where do they want to buy a car, where do they want to go on holiday. If your liabilities are in the UK and your future liabilities are expected to remain here, then that fact needs to condition how you invest your assets. So to some extent, you take an additional risk if you branch out into another currency from your liability currency. Now, that's worked very successfully for many people who've embraced the sort of S&P 500 story over the last 5-10 years. It's been a brilliant investment strategy. But these things don't go on forever. And I think it's important now to sort of rethink that. Look at it through the lens of valuation. Look at it through the lens of has the long cycle of dollar strength come to an end? I don't know. It looks like it has. And think about multiple things before they decide, well, yeah, I'm just going to carry on having 70% of my assets in the dollar. That might have been a windfall that many UK investors have enjoyed over recent years, but that windfall may not continue. So, and I've been an advocate, as I've said for months and months now, an advocate for at least some reappraisal of the fortunes of the UK equity market, which has been an underperformer for a long period of time, but which outperformed most other developed economy global markets last year, where valuations remain unbelievably low, and where I believe the economic outlook is getting a lot brighter. And I was quite pleased this week to see that a relatively prominent economic journalist wrote a very positive article in in the Daily Telegraph about the outlook for the UK equity market and about the outlook for the economy. Talked about a boom, in fact. Now, that's the first time I've seen anybody say anything like that. Anybody who's relatively highly regarded and respected. So I was quite encouraged because at last somebody seems to be agreeing with me. But anyway, let's see where we go. But I think these are things that investors need to think about for sure.
Second question, Neil, on currency. For a UK investor who might hold dollar assets, how do you think about whether to hedge or not?
Well, you've got to think about a number of things. You've got to think about how attractive is the asset first and foremost. Secondly, what your view on the currency is. If you are a dollar bear, if you think the dollar's going to hell in a handcart, then you've got to factor in a significant headwind to the returns that you think that your underlying investment will deliver. So it's a balanced view. And in the past, I've tended to take unhedged views because currencies are hard things to call in the short term. Broadly, when I've thought about currencies, I've tended to think about, well, how do I think this economy is going to perform going forward? And if you're worried, like I have been on various occasions about, for example, the UK economy, I've been worried in the past. I've been worried about emerging market economies, and that's been reflected in very weak currencies. The trials and travails of the Argentinian economy, for example, have been reflected in its currency collapsing over a long period of time. So you've really got to think about that if you're delving into some of those emerging market capital markets, and I saw that the Indonesian currency collapsed this week, or is it last week? Very recent, anyway. The Indonesian currency collapsed, and of course, from time to time you do get these crises of confidence in emerging market currencies, but in general terms, I think that currency calls are not something that I've seen anybody do repeatedly well. It's pretty tough.
Well, last question. Somebody's got 30 minutes this weekend to look at their strategy. Where should they start?
I think, like I said before, I think they've got to think about their investment strategy has got to be conditioned by what are they trying to achieve, what are their long-term goals, where are their liabilities likely to be in the future, what is the purpose of wealth creation, if you like. Once they've got a clear idea of what the ambition is and what the target is, then they've got to construct a portfolio that they think can deliver that. And you've got to think long and hard about the sorts of risks that you embrace when you build that portfolio, the economic, corporate, and currency risks. How diversified do you want to be? How focused do you want to be? And really, and in all of those things, valuation should be at the heart of every single investment decision. Valuation is the thing that, Warren Buffett, he drones on about it. I've droned on about it. Probably very boring, but it is absolutely essential. Don't overpay. Simple as that, really.
Neil, thank you, as always. Before we go, a quick reminder, we are not giving financial advice here. We're just sharing how we think about markets. Always do your own research. Always talk to a professional if you need to. If this was useful for you, please do consider subscribing wherever you're listening and leave a comment down below. It helps more people find us. Of course, you can send your questions in via the comments to Neil, and we'll do our best to answer you over the weekend. We'll see you next week. Until then, take care.
Bye for now.